with today's topic of correction wave models. Please confirm to me that sound and video quality is fine, so we are moving further. As you may have noticed, together with Tickmill broker, we have started a series dedicated specifically to Elliott Wave Theory under name of Elliott Waves from A to Z. We have provided the first session of webinar last Wednesday, and there are going to be a few more upcoming sessions where we are digging into details of trading using Elliott Wave tools. Just to notice, you may post your questions in the chat section. As for me, my name is Rowan, and I have recently focused on so-called naked trading, or trading without technical indicators. This method includes Elliott Wave Theory that we will examine during today's session. For agenda, we are covering different types of Elliott Wave corrections, and we'll in particular cover zigzag model correction, flat model, and descending triangle model. In case you've got previous experience with Forex trading, you probably know that any winning trading strategy won't be working sustainably without a proven and trustful partner. This is important to be educated not only in trading skills, but in trading conditions as well. So please have a look on features offered by Tickmill. If your broker doesn't provide you with such essentials as competitive spreads, segregated funds, and lack of free quotes, you'd better think of it once again. So we start with a short wrap-up of the previous session, where we have got the introduction to Elliott Wave Theory. The author of it is Dr. Ralph Nels Elliott, who has made up the general wave principles described in his book Nature's Law, The Secret of the Universe. So, as you may know already, main idea behind the Elliott Wave Theory is its natural order, which is present in market movements and market activity as well. And the other purpose of universal kind of the market. So all of the models that are described on specific time frame are just parts of bigger models, and themselves consist from small models as well. It is displayed on the following slide of standard Elliott wave cycle. In general, the complete cycle can be distracted into two pieces of impulse and correction moves. And as you can see, each wave can be distracted into pieces. So in case of impulse waves, it has an inner structure of an impulse itself. Same for correction, but vice versa. The first model we were describing during previous session was trend impulse. I'm reminding you on trend impulse for purpose because the first correction model that we will be covering in the current session has a very similar structure to a trend impulse. So impulse itself is a model of 5 waves. 3 of them are trend waves and same structure. and move along trend direction. Two are corrective. On the scheme, the trend impulse is on the left side. Wave 2 never retraces more than 100% of wave 1. Second, wave 3 cannot be the shortest between impulse waves. That means between waves 1, 3, and 5. Third, wave 4 doesn't overlap price range of wave 1 except from diagonal triangle. And fourth, wave 5 finishes above wave 3. These rules cover the first part of the scheme we are seeing on the slide. Going forward, we are going to start with a zigzag correction, which is easily described as ABC model on the right part of the same screen. So zigzag is one of the most common correction structures in financial markets and forex market specifically. It has 5 to 3 to 5 structure. That means that waves A and C are impulses and wave B is correction. What does it mean? When the zigzag correction starts to make up, it can be easily messed up with the trend impulse, which is forming up in a different direction. Just imagine that we do not have the numbers and the finished structure of the wave because it's being developed in live market conditions. And you see that the first wave that we already know, it's wave A, has the 5 impulse structure, which follows with a 3 wave or any different kind of correction waves B structure. And then follows C, which is again has an impulse structure. So by that moment, you may have doubts if it's a correction model or is it a new trend which is forming up. This is the idea why you need to stay careful with the zigzag correction. Let's try to explain this on an exact example. So that's a kind of zigzag correction that could be found in real market. On this screen, we are having Australian to United States dollar in late July, something like 2 months ago. In red form is chosen a zigzag correction model to bearish main trend, which was lasting for about a week. By the way, it's a 1 hour time frame. The correction has started on 20th of July and has finished at 22nd of July. It had an upward direction as the main trend was bearish at that time. So it can be easily seen that it has a 3-wave structure, which we have already marked with A, B, and C. Going deeper, you may notice that wave number A has a very basic impulse structure, and the same occurs to wave number C, wave under letter C. Whereas wave B has a easily visible 3-wave structure. So I will mark it in yellow now. This is the end of first part of the wave. This is the point of finish for second part of the wave, and of course the start of third wave. If something is unclear, please post it in the chat. We are coming for next update. Once we understand what is the main structure for zigzag correction, it's high time to understand what are the irregularities which are specific for zigzag correction model. It turns out that there exists a certain ratio between waves A and C. As a rule, C wave corresponds to 61.8% of the length of A. Other option, it could be equal or practically equal in length, that means in pip value, in comparison to wave A. And the third option is that wave number C is significantly longer and corresponds to 1.618 ratio in comparison to wave A. And in the exact example we are displaying at the moment, which is hourly time frame for Australian to United States dollar currency pair, we see an example of third option, where wave C exactly corresponds to 1.61 and date ratio. If you are wondering what the idea lies behind these exact numbers, if you've got a basic information about Fibonacci ratios, then it's probably out of question for you. In case you are not familiar with the main Fibonacci ratios, I recommend you to go into our webinar section and check in the recordings of the previous webinars, where we are covering in few of them Fibonacci theory and specifics. Now, when you know how zigzags look and what are the similarities between the structures, another important moment is understanding how it actually works for your trading. Main signal line for zigzag correction is called 0B. That means that it connects the very start of the correction model. At the same time, this point is the finish of previous impulse part, and connects it with the finish point for wave B. If you provide a trend line between these 2 points, you will receive a 0B signal line, which works at the end for zigzag correction. As you may see, after C wave has finished, in some time later in July, appeared the turbulent time of testing the area of this signal line. During the first 3 attempts, the Australian dollar was resistant to further decline and even managed to produce an upward spike, which itself could be a possible entry level. If you are a conservative trader, you would probably not get into such trade because one of the basic trading rules says it's only possible to trade in the direction of the trend. Once we understand that in the current position, the trend direction is bearish or downward, the only option for conservative traders is opening a short position. And the entry point in case of zigzag correction is the moment of breach for the signal line. So for the first time, the Australian to United States dollar pair has finally broken the signal line, which marked the continuation of the downward scenario. And even if you are a active trader, you are able to see that such an entry point provides you a good and profitable result. If you're less resistant to risk, there are different kind of understanding. If you're having, if you are looking into correction or trend impulse at the moment, good way is to analyze how the next wave after wave C, or you may probably know it as wave 3, works. So once you see that this wave is getting a form of impulse instead of correction move, as you could have been expecting in case of missing zigzag correction with trend impulse, you would be able to enter the trade earlier. Anyway, signal line is very important when trading zigzag correction, and certainly it's a very valuable tool for your day trading. In case you have got some questions regarding zigzag correction, we would be able to turn to the topic by the end of the webinar. So you can put questions in the chat section. And we are moving further to a second type of basic correction models, which is flat correction. I would like to notice that flat correction is known as the most popular correction type of movement for Forex market specifically. So if you are trading Forex, I recommend you to pay extra attention for flat correction. So flat has 3 to 3 to 5 structure, where A and C waves are corrections, and B has where A and B has 3-wave correction, and B is impulse. What are the main positions for flat correction? It could be corrective waves, or waves 2 and 4 in trend impulse. It could be any wave in terminal impulse or any wave in triangles. It can be B wave in zigzag, which has a 3-wave structure. It also can be a part of a bigger flat correction. In that case, it's A or B wave itself. And finally, it could be a X wave in complex correction models. Let's see how it works in details. So the chart given is a 4-hour time frame for euro-dollar, so the most popular currency pair. And if you have been trading it in the beginning of year 2015, you probably remember this flat correction, which appeared between levels of 1.8 and 1.14 in value. So short history, we see that the price is moving in an upward direction from the bottom of 10520 and it finishes in the area of 114. After this, we see a correction type, which we already know is called flat correction. And the irregularities of it is that the lengths of all three waves included in this model, A, B, and C, is practically equal. Wave A has a remarkable three-wave structure, 1, 2, and 3. Same goes for wave B, 1, 2, and 3. Whereas wave C has got a bit more complex five-way structure. So the flat correction finishes around the static level of previous A bottom, and after that it produces yet another impulse, which leads to the recent high posted last month. A short notice that flat correction could be extended. So in order to understand it, you can just scale or multiply the visible model into more parts. As we have noticed before, A and B parts of flat correction could be flat corrections of lower scale by itself. Third type of correction is known as contracting or symmetrical triangle, and probably it's the most sophisticated type of triangles. On the schema it looks following. In the rising market, the triangle direction and the development stays below the recent top, and the breakout goes to the upside. During the falling market, the values of symmetrical triangle stays above the recent low, and the breakout goes in the bearish direction. Main feature of the symmetrical triangle, which has got A, B, C, D, E structure, is that all the waves are descending in comparison to the previous one, which means that usually wave A is the longest one, whereas final waves D and E are the shortest. So, in other words, each consecutive wave is smaller than previous. This specific principle helps to easily understand when the contracting triangle is being developed on the market. The same as in the nature, of course, sometimes there are present exclusions. And the specific kind of exclusion is presented on the visible scheme at the moment, where wave B is the longest one. Another type of exclusion is rather rational because it presumes that wave C is the longest. If we convert lettering to number count, you may notice that C wave could be similar to a third wave. So you could imagine that this example is quite common, despite it's an exclusion from the main principle. So let's see what are the signal lines. The first signal line is 0B, and it connects the beginning of correction structure with the end of wave B, and it determines start of wave C. AC line in turn determines the end of C line. Finally, B and D is the most important signal line because it indicates the finish of correction model. It looks like this on the chart. So the first line is 0B, and it's provides a dynamic resistance at certain point. AC line, which is the second one, gives in return a dynamic support level. And the core signal line, I will mark it with different color, unites the lower part of the price model. So as pictured on the screen, once you see the breakout from B and D line, which is confirmed with the break of 0B line, you probably see you definitely see the finish of a correction model. Let's see what are the main principles and rules that we have learned during today's session. First, Zigzag starts development as trend impulse, and that is why you need to be careful with wrong signal. Second, flat corrections are widespread in Forex market and are recognized to a specific 3 to 5 structure. In other words, you know from the start that you are dealing with a correction model. You cannot get caught, as in the example of a zigzag correction, when you can initially pretend it's actually the start of trend impulse, which is not true. So for trading signals, flat corrections usually provide more specified signals. And finally, contracting triangle is extremely useful as it suggests clear entry signal or breakout from B to D line and stop loss level, wave point of the finish for wave E. Before we finish this session, I would like to get back to the concept of correction moves itself. If you are already familiar with the markets and Forex market in particular, you know that any market movement can be identified as trend movement or correction movement. You may have proven it with your own experience as well, that sometimes correction phase or flat phase for the market, which is just another kind of correction, as we have described in the second part of today's webinar, takes a longer time. At the same moment, there is a rule which says that you need to follow only trend direction. How does it apply to your trading? That is the main question that you may have been asking yourself. For conservative traders, the right answer is you should not trade during correction phase. The following question then is formulated like this. What for is understanding the details of correction moves once you see that once you put restrictions that you are not trading during correction phase. It could be reasonable because there are just 3 types of impulse moves, but more than 15 types of correction scenarios. And as a rule, correction options are much more diversified, so it's clearly more complex to understand and apply them on the market in comparison to impulse. This assumption is logical, but the reasons behind such logics are wrong. In case you're familiar only with impulse waves, you won't be able to understand the point of finish for correction waves. So even if you are not trading during the correction phase of the market, you still need to cover it in details and try to understand which model specifically you are trading with, we are dealing with at the moment, what the exact part of this correction model, and main question is where does it supposed to finish? Once you are trained correctly with the correction wave models, you would be able to understand rather specifically at which price level and at what time period you expect this correction model to stop or finish. When you know at least the basic correction models, you are able to understand which wave is going to be the final one for it. The very best aftermath of such understanding is that you get a better entry point for the for your trade in direction of main impulse. It would be the same winning trade in comparison that if you have entered the impulse without knowing the details of correction. But the primary difference would be the number of pips that you could have fixed choosing between correction entry point and impulse entry point. I would like to get back to the example that we were having during today's session on zigzag correction. If you are familiar only with impulse models, you would be able to enter the trade only after the signal line is breached. So once this line is broken, you have got a rather clear indication. Okay, this is not an impulse. So the impulse move is going into bearish direction, and I'm going to sell. So there are 2 options. You either enter sell in the area, in the price area of B wave, and you have lost a few dozens of pips already, or you are trying to wait until the correction into opposite direction to have a better entry point. And as you can see in the particular example of this chart, you may even lose the whole position because the currency pair starts to decline sharply right after the signal line is broken. The other option is having an understanding that you are dealing with the correction model. This understanding gives you the opportunity to enter the trade in the right direction of the trend much earlier, even before the signal line is tested. Of course, you need to follow your stop losses and compare possible outcomes following the risk ratio rules. It's more about risk management than types of technical analysis, but it doesn't touch the universal truth that general understanding of correction models is dedicated not to trading during the correction phase, which is rather risky and sometimes very negative to your trading account performance, but it could be used very efficiently for an effective market entry point. I hope that today's information was clear for understanding and also useful for you. I personally see such models as zigzag correction and flat correction and contracting triangle in its multiple variations every day on different currency pairs chart. So right after the session, I invite you to open your own chart and have a look for zigzags and flat corrections specifically. Once you test these tools on demo account, it's high time for you to check its performance live. That is the right time when Tickmill can help you. The broker offers you classic account where you do not have to deposit as much and where the trading conditions are nevertheless great. With Tickmill's classic account, you can enjoy trading with quite low spread that starts as low as 1.2 pips for euro dollar. In addition to this, there are absolutely no commissions attached to this account. This is quite an important feature for the beginners as it lets them to focus primarily on the market without spending time on calculating the profitability due to the commissions. That's it for today's session. I would like to thank you for your attention, and I also invite you to ask the questions about the topic we were covering specifically today. For if you are curious or unsure about any details in Elliott Wave correction models, feel free to ask them. And by the time you are making up your mind, let me describe you in short what we are doing next. As I've mentioned before, this webinar is a part of a bigger series, which is called Elliott Waves from A to Z. And it's being held every week in September, every Wednesday at 12 o'clock Greenwich time. So in the previous parts of webinar Elliott Waves from A to Z, we have covered general trend and correction models which are used in day trading. Also, you will see many of examples of zigzags and flat corrections in the market. It will become for you clear rather quickly that there are different complex types of corrections, specifically corrections, which are not visibly the same as the covered models. They are called complex correction models, and we are going to get deeper into them. They are more tricky to be identified, but really improve your trading accuracy and market understanding. So in the next session, we will concentrate our attention on complex combinations that have X waves embedded in their structure. Such formations often get double or triple structure, which leads to a more volatile impact. Popular Elliott wave concept of expanding triangle is another example, including X waves. If you are able to join us next Wednesday, I would be pleased to continue describing and analyzing markets with Elliott Wave Theory. And by now, I thank you for your attention again, and wish you a profitable trading day. Bye.